You're about to hear my conversation with Richard Wong, who leads our condo franchise. We talk all about how he approaches the value space, what the difference between deep value, cyclical value, and quality value is. And we also talk about individual names that he is currently finding attractive. I hope you enjoy. This podcast is for informational purposes only. Information relating to investment approaches or individual investments should not be construed as advice or endorsement. Listeners should seek professional advice for their situation. Welcome to the McKinsey Investments Podcast. My name is Matthew Schnurr, and I'm delighted to have Richard Wong, who leads our condo investment team, back. Richard, welcome.
Hey, Matt. How are you?
I'm very well. Thanks for asking. And thanks for taking the time to speak with me today. Always love hearing from you, Richard. And what struck me about this conversation, and just to start off, we rarely talk about performance, but taking a look at your performance as of the end of August in 2023, the Condo Value Fund is actually top decile in 1 and 3 years. And it's not an intuitively value-oriented market. Clearly, kind of very much known for value. Maybe we can get into some of the ways that you can approach value and that have led to that performance. So why don't you start by telling me how you view markets and value investing as a whole?
Well, thanks, Matt. I would start by saying that it is being a much more friendlier market to value the last few years, even though people think about this year and they think, oh, NVIDIA, AI, and so
Sure.
on. But it's been a friendlier market to value basically since we stopped having zero interest rates and zero inflation. I had talked about in previous podcasts that when we have positive inflation and positive interest rates, it's generally a tailwind to value because we're not fighting with, people able to borrow at $0 to buy whatever story they want to buy in the market. But in terms of the value spectrum, we look at value in different ways, and we're always buying out of favor stocks, low multiple stocks that are very often hammered in price action. But we broadly look at the type of names we look at in 3 buckets. There are the deep value that condo is known for, which are problematic stocks in restructuring, turnaround, hairy stories, very, very cheap, but needs X, Y, and Z to happen for the value to surface. Then there's cyclical value, which are, cyclical sectors, and we tend to focus on leaders. And during a downturn in that sector, they could be very cheap. And there's also quality value in our minds. Quality value are stocks that trade at low valuation, but they're largely non-cyclical. They have consistent cash flows. They would have strong balance sheet. They might even pay a dividend, but really low valuation stocks, they are non-cyclical and have more consistent growth. And we pay attention to quality value as well.
That's great, Richard. I want to sort of do a double click in each of those 3 different categories, and specifically thinking about the past 3 years, how you've thought about positioning the portfolio in those 3 different groups. I think the easiest one to start with is deep value, which is the one that you started with. In this case, seems fairly idiosyncratic. How do you view deep value? How do you think about constructing it within your overall value portfolio?
So deep value is opportunistic. Deep value tends to be idiosyncratic stories. One particular company that has a management change, or one company has a lawsuit, and or maybe multiple earnings misses, and therefore
Right.
It's fallen deeply out of favor. In my experience, and I've been in this business 20 plus years, the market goes up and down in cycles. And from my observation, earlier on in an economic cycle, the both deep value and cyclical stocks are very deeply out of favor, very depressed, very cheap, and it tends to be cyclical stocks that rally out of a downturn because
Okay.
they participate in an upturn, economic recovery. They have a lot of operating leverage. They're usually trading at very low valuation, and people start having hope about the economic cycle. And then when during more mid-cycle, when people have more risk appetite, market sentiment is strong, that's when deep value, when they work, does extremely well. People have markets have appetite for taking on risk. They want to reward companies for fixing themselves and so on. And near the tail end of the cycle, it's where we focus on quality value. These are companies that are less volatile. They have strong balance sheets, and because they're not cyclical, we're less concerned about the emergence of a deep recession causing these types of stocks to go down. So we will shift our portfolio amongst these exposures over an economic cycle. So that's how we do it. So right now, deep value is not a huge part of the portfolio. We have quite a number of names that are deep value, but we control the exposure because in this part of the cycle now, we think we're kind of late cycle. We're waiting to see either we get a soft landing or maybe we actually do get into recession. Market is jittery about that. It is time to focus more on quality value. So we've controlled the exposure we have to deep value.
That's a perfect explanation on deep value and how you think about it in the portfolio. Even give me a sense going back 3 years. It feels like we've lived through a market cycle during the 3 years, given what's transpired, COVID, sort of the post-COVID boom, and then of course the rising interest rates and inflationary environments. What has been the exposure to deep value over that time? And maybe even give a few names of companies that exhibit those characteristics.
That's a good question, Matt. And so, we were, watching the development of vaccines very closely at that time, I remember. And from our work, it was pretty obvious that by November 2020, we were going to see some sort of announcement from Pfizer and BioNTech and so on. And we thought that things are so negative that any sort of positive announcement or mildly positive announcement was going to shift the market's focus back into a recovery from the COVID-led recession. So we started shifting to cyclicals. Ahead of at that, we started shifting to cyclical in September, October. So once you get into Q4 2020, Q1 2021, there was a huge rally in cyclical. So we really benefited from that because we had dialed our cyclicals back to about over 60% of the portfolio was cyclical at that time. Deep value also, we added to deep value at the same time, and it got to probably around 22% of the portfolio was the deep value.
Okay.
Some of the names that we have in deep value now, we own some of them we've owned for a number of years. We own a name called SNC Lavalin,
sure.
Canadian company.
And they had the scandals. Is that the overhang that was leading to the valuations?
That's right, and that started back in 2019, and the stock went from 60 to like under $20. So that was a classic deep value. Lots of risk, lots of headline risk, but from our analysis, some of the parts there was a lot of value, but they have to clean up. And they've been spending the last 3 years cleaning up. They have to exit the fixed cost contracts that they always have cost overruns. It's not a very profitable business. So they're now coming to the tail end of that. And they have reported very good quarters recently. Their engineering service business is doing really well. They're a global leader. There's a lot of infrastructure spending going on in the US, especially with the bills that have been passed. And they have some hidden assets. They still own like 6.7% of the Highway 407, which we believe they can sell and raise cash and maybe use that to make acquisitions. So it's a very dirty story becoming a very clean story, and that stock has done extremely well this year.
Great.
So that's really how another deep value story that we got into just earlier this year, Alstom, which is a French train equipment, passenger train manufacturer, global leader, and they got into trouble by buying the assets from Bombardier.
Right.
And they were loss making, caused them a lot of trouble. They lever up, so the stock got really hit, and it's in deep value territory, and they have to cut costs and fix the Bombardier contracts that they deliver. I mean, they took over, and they have to deliver, and but once that's done, they are going to be one of the top. There's only so many passenger train manufacturers out there. They're one of the two. Siemens is the other one, and there's a Chinese one too, but they don't tend to sell much in developed markets. So that's a lot of upside. Electrification, autonomous driving for trains, EV for trains. They're a leader in those areas, so they're in the midst of a turnaround right now.
Two great examples to give a flavor for that. I want to move to cyclical value, which is sort of the second one that you talked about. You talked about increasing the weight of cyclical, sort of in lockstep with deep value around the vaccine announcement. I'm curious, one, where are you currently with cyclical value exposure in your portfolio? And then two, also maybe give us some examples just to make it a little bit more tangible of companies that fit within that that you've been investing in.
So yeah, I go back to talk about that cycle, right? As that cycle continue on, we ended up getting into very high central bank hiking rates and so on. So we got concerned about consumer and so on, like a lot of folks are.
Sure.
So yeah, over the course of the last 12 months, we've dialed down both deep value and cyclical value, and quality value is the largest bucket now in the fund. At about 44% of the fund is quality value. But we still have exposure to cyclical value because they are very cheap and is not absolutely sure that we will get a recession.
Right.
So there's a balance of, we could get a soft landing. So likelihood is looking a little bit better. And we don't know for sure. We don't forecast this. We just look at the actual data that comes out. So there are a lot of cyclical stocks that are very cheap. And if we were to avoid a recession, they would do extremely well. So one name that we own right now is Daimler Trucks.
Sure.
It's a German company. It's a spin-off from Mercedes-Benz.
Right.
And they're the global leader in trucking. Large trucks, like these are 16-wheelers, 20-wheelers, and they have a quarter of their valuation market cap in cash, very healthy balance sheet, global leader, nobody is as big as they are. They own all sorts of brands, like Freightliner is one of their brands. Obviously, Daimler is one of their brands, and they are a leader in electric-driven trucks as well. Software. So there's we do have exposure to, I mentioned Alstom, similarly. I mean, we don't just buy the themes, but if there are themes that like EV that could be great for the long term, and we're not really paying for it because these stocks are so cheap, then that's great. So Daimler Truck is great. It's a cyclical. It's not that cyclical. A lot of spendings has to be done, whether there's a recession or not, because fleets of trucks have to be retrofitted to be greener. So they benefit from that. So that's one cyclicals we have that we really like right now.
Great example. Same question, Richard, but why don't we talk about quality value this time? So it seems like we talked a lot about reducing of weights in both cyclical and deep value. Quality is going to be the other side of that coin. And right now you mentioned 44% of the portfolio in quality value. What are you looking for, I guess, right now as far as increasing or decreasing that weight to quality? And then maybe give us some examples of some names that you found within that space.
Some of the quality value we were able to find actually during the pandemic. Like for example, in our minds, TJX is a quality stock. It's a bargain. These are right. This is Canadian Winners. It's owned by TJX. Sure. Yeah. Right, during an economic tough time, consumers look for bargains, and this company is able to buy bulk and discount, sell them branded products, fashion at a discount. Which is, I think, very resilient in the environment we're in. We bought this during the pandemic when most of the stores were shut down. Right. And the stock plummeted. And we thought we felt that pandemic wasn't going to last forever. And that's, sure, how we, from our research, that's what we believed in, and it turned out to be the case. And so that was a quality stock, a quality retailer, not very cyclical, very resilient, that we were able to get at bargain prices during the pandemic. And other quality stocks we own include Comcast, which is the leading cable company in the U.S., and they own NBC Universal and so on. Right. Very steady, growing cash flow, pays a dividend, recurring revenue, but trades at a very low multiple, like low double-digit PE. And another quality stock that we've actually had for a long time and added to in the last year is Oracle. Oracle, sure, it's a huge lagger in the tech space. It's not been perceived as a growth stock at all over the last few years. They've been a lagger in transition to the cloud, but they're really catching up now. Our analysis shown that they could have increasing amount of revenue coming from the cloud, and that's turned out to be the case over the last few quarters. So the stock has performed very well this year, but we had to wait. But they're delivering now, and we still see compelling valuation in a name like Oracle. So when we look at quality value, there are steady growers, They are non-cyclical companies, but generally have strong cash flow characteristics. And these are the type of stocks that even if we were to have a deep recession, they will hold up very well.
That's great, Richard. I do want to come back to this concept of rotating between these three different buckets of value and what stage of the cycle these tend to perform well in. And I want to marry it and try to understand your comment where you said, but you don't forecast where you're going. So without forecasting, how do you just determine what the right amount is in cyclical versus quality versus deep value?
Well, it's not an absolute number. We don't draw a line in the sand and says, "Oh, this has to be one third." I mean, the decision is driven largely by bottom up. It's a bottom up selection process, and we pay attention to both the macro data, purchasing manager index, unemployment,
right,
bank lending, and we pay attention to the company's bottom up comments that they deliver quarter after quarter, and the shifts that we make are quite gradual. They're one stock at a time. For example, one case in point, early days in the recovery from the pandemic, we had a lot of financials.
Okay.
The yield curve was steepening, consumer spending was accelerating. It's a great time to own banks, and we had quite a lot of exposure in financials. But as the cycle continues, and we're hearing about, not only are they lending higher rates, but deposit rates are higher too. They have to pay out more in deposits.
Yeah, of course.
So we're hearing that pressure. We're also hearing that after the initial spending, consumer borrowing seems to be a little bit weaker. So when we hear that, marry with the fact that we monitor, PMI and confidence numbers and so on, then we gradually go, okay, you know what, maybe we don't need a 3% weight in this bank. We should just reallocate, take some of that off and look for more defensive names that we could, So it's a gradual process. It's not a hard number. We obviously look at the benchmark. We're not blind to the benchmark, and so we go like, do we want to be more defensive than the benchmark? Should we be more aggressive than the benchmark at this time of the cycle? So those are the kind of things we think about.
That's great. And just to put a finer point on that, it sounds like while you don't forecast where markets are going, understanding where the market currently is really important. You've referred to a few metrics, but maybe elaborate on that. Like, how do you know what part of the cycle we're currently in? Is it simply following PMI and unemployment and that type of thing, or is there more to it?
Following the macro, definitely. I mean, over a trend. I mean, you see. There's an inventory cycle, for example, right? We follow that, and you can expect a certain market behavior at certain times when we're in a negative territory for inventory, PMI numbers, and so on. But also we look at market action, day to day,
right,
and that tells us how people are positioned. So I mean, that just used as it's almost like just you're driving on the road, you're looking at GPS, but you're also looking at the traffic around you. So I think that's in combination, looking at market action and just kind of like the macro is kind of the GPS. But we don't know precisely exactly where we are, but we know where we travel. So if we see numbers softening, then we know that we're probably through the peak.
Right.
We don't know exactly how long the end is. Like, you don't know where we are in terms of are we end cycle? Does that last for a few more quarters, or does that last for just a few more months? We don't know. We just have to manage risk, and we don't make a dramatic shift until we see more clear signs. So, for example, for us to contemplate becoming more aggressive in cyclical again, or deep value again, we're going to have to see either the rate hiking cycle is totally behind us and they're going to go down. Rates are going to go down, so that will stimulate the economy. So that's going to give us hope that we might see a beginning of a new cycle, or we're going to see that there's the risk of recession continue to recede. There's reacceleration in consumer or business spending, for example,
right,
or we have to see something dramatic coming out of China. This rut they're in, they're going to find a way to get out of, which we haven't seen evidence of that. So we look for those major changes to tell us that, okay, chances are things are turning and we should reposition, that because usually during those turning points, some parts of the market is really cheap, right? Like right now, when those turning points happen, cyclicals are really cheap, and they're going to give you better upside than quality. But quality will give you less downside right now. So
Right.
when you're late cycle, you want to worry about downside.
So it sounds like right now, and based on the 44% of the portfolio being in quality value, you think that we're sort of in late cycle. Maybe talk us through some of the opportunities that you're seeing. What are you seeing that is cheap out there, and where are you putting capital to work?
Well, we're putting in capital to work right now. They're kind of very stock by stock,
Yeah.
because we feel that the exposures and positioning of the portfolio is correct right now for where we are in the cycle. We got a lot of quality, but we're not void of cyclicals. We see opportunity cyclicals. They're going to take a little longer, and we kind of manage a position size, So the cyclical exposures are not that big, but they're in terms of opportunities, there are a lot of opportunity. I mean, they're more like a single name opportunities. We think in the U.S., we talk about stock names again. Dollar Tree it's got a lot of upside potential. They're early days in breaking the buck. They got new management team, and this is an investment year. They have to invest in systems and so on. So the stock is held back, but we believe that they have a clear path to transitioning to a multiple price point. And in a recession environment, there are bargain hunters and treasure shoppers that would like to shop at those formats. So they have to go through this, and there's a lot. The stock is depressed, but we see a lot of upside. They're well behind where Dollar General and Dollarama had done historically. So there's a lot of catch up to do. So we see this as a multi-year opportunity. We like tech resources in Canada. They're in a process where they discussing potential buyers of their core assets. We think if and when they can find a way to resolve that exposure, it becomes a very clean copper exposure. Copper is a clean metal. It's a green metal. Electrification requires a lot of it. And they have one of the biggest new growth areas for them, the QB2 mine, and then more they will develop. So they are one of the few copper giants out there that have new copper mines coming to the market, where it's very tough to bring a new copper mine to the market. So we believe that could be very valuable, and that stock would do even better if we can get out of this recession concern that we have around the world. But that's a very good idea in my mind. Great play, tech, both splitting up the two different types of raw materials, and also longer term electrification and the rarity of being able to bring copper to the market. And we like cloud transition stories. They have done well this year, but they are a cheap way to have exposure, and they're still trading below their intrinsic value. Names like I mentioned Oracle, but SAP as well. Those stocks are held in a lot of different portfolios out there. A lot of core portfolios might own them. We had them for quite some time when they were not when they haven't done so well. They were huge laggers. Now they're catching up. So that catch up for cloud transition for them and by their customers, still got a long ways to play out. So we like those as well.
That's great, Richard. Really appreciate you spending time with me, walking me through the process, hitting on different stocks and different elements of value. I thought it was a really engaging conversation. So thank you so much.
It's great talking to you, Matt.
The content of this podcast, including facts, views, opinions, and recommendations, is not to be used or construed as investment advice and is not an offer or an invitation to buy or sell any security. The content of this podcast should not be relied upon for any purposes, and Mackenzie Financial Corporation is not responsible for any reliance upon it. This podcast includes forward-looking information that reflects our current expectations or forecasts of future events. Forward-looking information is subject to risks, uncertainties, and assumptions that could cause actual results to differ materially from those expressed herein. Our views are subject to change based on market conditions. Commissions, trailing commissions, management fees, and expenses may be associated with mutual fund investments. Please read the fund facts and prospectus before investing. The indicated rates of returns are historical annual compounded total returns, including changes to unit values and reinvestment of all dividends or distributions, and does not take into account sales, redemptions, distribution, or optional charges or income taxes payable by any security holder that would have reduced returns.